Hey there, Galen Nuttall here, and welcome again to Canadian Whiteboard Finance. This is the place where I help make complex financial concepts simple for Canadians. And in this video, I'm continuing the series around this concept of infinite banking. Infinite banking. Which is a concept that I'm getting a lot of questions about. In my own Facebook newsfeed, I see ads for different people in Canada promoting this concept of becoming your own banker, beating the bank, banker's secret, banker's vault. There's all these different names that are applied to this. And in today's video, I'm going to talk about, what is it? Like, just really get to the root of it. Because sometimes people will call me and they say, I'm reading the books about it, I'm watching the videos about it, but I just don't get what it is. And one of the big questions I get is this a philosophy? Is it a belief system? Is it a movement? Or is it just a product? Like, can you just clarify that for me? And so like people have called me and they've said, just tell me how this thing works. Like I don't want to be a part of a movement. Just tell me how it works. And so today that's what I'm going to just focus in on is like, is it a product? Is it a philosophy? And then exactly what is it and how does it work? So I'm going to share my whiteboard and let's get started. So when people come to me and they're a little bit unclear as to what infinite banking is, they've come from different spots. Like some people have read this book. I know I'm small enough, you can see it, Becoming Your Own Banker by Nelson Nash. They've either read the book or they have watched videos of people talking about the book. There's some concepts in that book or some things about that book that I really agree with and think are applicable, and there's some things in there that I don't agree with entirely. And so I have other videos where I go into that. CFP review, Canadian CFP reviews Becoming Your Own Banker. But today we're going to focus on people have read that book, and there's a bit of philosophy, there's a bit of product, there's like a lot of numbers, a lot of illustrations on how this works, and so people sometimes are left with this idea of I don't quite get it. Or like, is this going to apply for me? So when it comes to product or philosophy, I mean, you've kind of got this spectrum, which is like, let's say it's the philosophy side. And then you've got this spectrum over here where it's like, well, it's really just a product. And this whole, infinite banking, becoming your own banker, beating the bank, all this stuff is really just marketing. That's that side of the conversation. The reality is like somewhere in the middle. I mean, yes, to implement the concept that's in this specific book at the end of the day is to take on a product that's called whole life insurance and oftentimes referred to as investment grade whole life insurance, to be not confused with other types of life insurance. So yes, at the end of the day, you may, in this book, you will read more than 20% of the book before you find out that there's some whole life insurance going on in this. The philosophy around it is really, the philosophy is that you're taking this product and you're using it in a unique, creative way. So unique and creative. The philosophy is that you're kind of freeing yourself from the banking system. That's a part of it. Another part of it is like you're changing the way that interest works in your life. Like that's the philosophy side of things. That you kind of create one of these products to be like its own business. That's another part of it. And I'm not saying whether this is accurate or not. I'm just saying like this is the philosophy side of things. Product side of things is whole life insurance, and then you're going to take that whole life insurance and then you're going to take a loan against it in a special way or like in a creative way. The reason why it works is because that in Canada, the reason it works is because there's different acts. Like there's a bank act and there's an insurance act. So life insurance is treated different from a tax perspective than it's treated, and then like an investment, a regular investment would be treated. So it is definitely cool. It is unique. For some people, it's a really great idea. What I'll say is that also in Canada, there's another thing that makes it fairly attractive is that in Canada we have high income tax rates, we have high capital gains tax rates, and we have high taxes on death. Potentially, when someone passes away, sometimes they lose a lot of their estate to taxes. And on the product side, or taking on an infinite banking program can support with a lot of those taxation issues. So product or philosophy, it's somewhere in the middle. Like it's a philosophy, but it's a philosophy that's implemented by using a product, which is whole life insurance, and then in a sort of a creative way of borrowing against that whole life insurance and treating it in a different way. So disclaimers, as always, is don't make a change or take this on without consulting competent professionals in your life, like tax, legal, financial planner. Like be sure to, if you're going to implement anything, do so knowing full well how it works. Like in these videos, I tend to talk for like 10, 12, 15 minutes about this concept. If I were to sit down with someone and make sure it's a good fit for them, starts with an initial 15-minute conversation. But after that, we would have some very in-depth conversations to make sure that they understand exactly how it works and exactly how the ins and the outs work. So that's my disclaimer, is to consult before you implement, to consult competent people who understand how this concept works. And if you need to talk to your lawyer or accountant as well, like be sure to loop them in to the conversation. And the other thing is just make sure it fits. Like really do your due diligence and make sure that it's going to fit in your overall plan. Like it's a piece of the puzzle. Does it fit in your puzzle? Now, I don't want to join a movement. So this has happened a few times where people call me and they say, Galen, just tell me how this works. Just tell me how this looks in my life. Like, what does it mean? I get that there's this whole philosophy around beating the bank and, like taking control of things in our own hands. Like, I get it. Just tell me how it works. So when it comes to this is the movement side or the philosophy side. Sometimes you'll hear some people talking about things like this is going to replace your bank account, or this is going to be like a business that works for you. There's some elements of that are accurate, but also like today I'm just going to go into like what is it exactly. So first off, infinite banking, like I said, is a whole life insurance product or an investment grade whole life insurance product. Another way to call it is a participating life insurance. So how it works is an individual figures out, like, there is a life insurance component to this. Like, sometimes people come to me and they're like, oh, I don't care about life insurance. I just want to dump a whole bunch of money into this thing. And I'm like, yeah, like that's a bit of a red flag. Like, at the end of the day, it does have to make sense that you do need some life insurance in some way, shape, or form. Like to take this on solely for its, benefit of like some sort of like tax strategy doesn't usually make sense. So that's one thing I really have people look at. So the way it works is someone comes and there's usually one of two things. Someone says, okay, cool. I get that I have this need for life insurance. And also above and beyond that, I've got some need for I like the idea of having a place where my money is going to grow in a tax sheltered environment, and I can borrow against it, or it's going to go tax free to my beneficiaries. So what people usually come to is they say, I've got an idea of how much of life insurance I need. Now let's look at, am I going to make an annual deposit into this, or do I have a lump sum that I'm going to spread out over time? And the work of the financial planner is to take all these things into consideration to design, and this is a policy. This is put a P here and like some writing under it, to design a policy that's going to work for you. And I'm going to pull back the curtain here a little bit. A good advisor or planner, I won't talk about the difference between advisor and planner right now, but you can't call yourself a planner unless you have your CFP. A good planner will say, I get what you're trying to accomplish. So if you look at this as like you're here, you feel like you don't have this thing in place. You'd be better off if you had it in place. The step of the advisor is to say, okay, what is the big picture? What exactly are you trying to accomplish? And then looking at which company should we go to? Because there's lots of different companies in Canada. In my case, I'm licensed with several. So I go to the one that makes the most sense for the client. And then once we've got the company figured out, then it's how do we design the policy? So put a P here, and every policy has every policy that's properly structured, and you'll hear that word a lot in infinite banking, properly structured. It's not exactly rocket science, but there is work that goes into properly structuring a policy, and ones that are improperly structured don't work nearly as well. When you go to structure a policy, there's going to be a split of how much of the premium is going to focus on the death benefit. So I'll just put DB for death benefit, and how much is going to focus on the cash or the growth or the investment component, which I'll call cash value, CV. So for every dollar you put in, the question is how much should go towards this and how much should go towards this? And it's really a factor of, like I said, going back to the idea of the insurance, how quickly does someone want that insurance to grow? Is it a short-term, like a shorter-term desire? Is it a longer-term desire, like from an estate planning perspective? Really figuring out what works, and then looking at, is it going to be an annual premium? Is it going to be a lump sum spread out over time? Then that's going to influence how the policy is designed. And then eventually we get to the point where the policy is designed properly. Now, okay, so this is like the beginning stages of it, of getting it into place. Now, what are the next stages of it? Then the work is to say, okay, we've got this properly structured, what is it going to look like down the road? So this is the policy, the properly structured policy, PSP. And what is it going to look like in the short term? So like, let's say 5 to 10 years. And what is it going to look like in the long term? Like 10 plus 30 years. Okay. Now, in the 5 to 10 years, what we look at is, depending on what someone's trying to accomplish, it's what is the cash value going to be? And so now, to get into the nitty gritty of how does this work, is that you put premiums or deposits in every month or every year. And as time goes on, your cash value starts going up inside of the policy. Now, the reason why this is a unique and effective place to put money is that you can technically take this, whatever this policy value is, however many years out, and you can borrow it to use it for things in your life. So I could take that money and I could borrow it. I could pay for education. I could pay for a car. I could pay for things. And you'll hear people say, and I'm not going to talk about it today, but recapturing interest. That's a bit of a dicey approach to this, is looking at ways to recapture interest. So I'm going to do a whole video on that. But it does make sense in the sense of, if my options were to go and get a high interest loan, like I'm going to go get a credit card loan to go, let's just talk about something crazy. Go get a credit card loan to go buy a car. Like I'm going to max out my credit card to buy a car. Let's say that car is a used car and I'm going to use a credit card to buy it. $10,000 car. Doesn't make sense to do it if I'm going to incur like a super high interest. It could make more sense to take it out of a place like this, like the policy, because the rates are probably going to be better. There's going to be more flexibility about repayment. Like it's just, and the cool thing is when you borrow against it, do it the right way. When you access your money out of this, your money is still behind growing even while you're borrowing against it, which is very unique. There's not a lot of ways to do that. One of the easiest, if you've ever done a home equity line of credit, that's kind of a close comparison, because the value of your home is usually going up while you're borrowing against it. You're not actually taking your money like away from your house. It's actually still there. You're not taking your money away from your policy. So it's still left behind to grow for you while you're using the money. So you'll hear about people say, like, use your money in 2 places at once. Your money is still behind growing, and you're taking it out and using it either to buy something or to invest in a business. That's another option to take when you use this approach. Now, where it fits in the book. So if you pick up, the Nelson Nash book and you learn about it, where he fits in is like this approach, like I said, this philosophy of you're like, and what I just talked about was, if I were to take, if I wanted to buy a car. So here's my car, and this is going to be a horrible car, I'm going to tell you right now. I'm like, there we go, car. I could either go like one of the more traditional routes, where I could go to a bank, I could go to a credit card. Let's put a piece of plastic here. It's got a chip on it. It's got some words on it. I could go to these places. I could take the money, and I could borrow against it. And what's going to happen is I've borrowed, let's just say $10,000. I've borrowed that $10,000, and what's happening? I'm owing more as the interest goes up, right? Or as the interest, as it starts accumulating interest. Whereas with, and you don't have that money working for you anywhere. Like you owe $10,000 to somebody, and that's that. Like you don't have that working for you. Whereas if you were to borrow it from a policy, you borrow that $10,000, your money is still working for you as it's left behind. Like you're not actually taking the money out. The money is still there working for you. So it's actually growing. So that's like the biggest concept to understand when it comes to the short-term borrowing of things. Now, when it comes to the long-term, it's more around estate planning and tax savings around estate. So that's a bit about product versus philosophy. How does this actually work? If I've achieved that goal, let me know in the comments. Comment below. Let me know if you still have any more questions around product versus philosophy. If there's anything I said that you want me to clarify, something you disagreed with, go nuts. Let me know. If there's another video you want me to make, that's how I get my ideas for my videos, is interacting with people who have questions, because I don't always know what people want to know. As always, if you want to talk more about this, book a call with the link in the description, either with me or someone on my team, and we, in a very quick conversation, 15-20 minutes, I can ask the questions to figure out whether someone should look at this or not, and very quickly help you figure out, should you keep spending time figuring out how this thing works and learning about it, or does it not work for you? Or, yeah, like this could be a really good fit for you. Let's design something that works really well for you. So thanks again for joining me on this video, Canadian Whiteboard Finance, around the topic of infinite banking, product or philosophy. And yeah, I'll see you in the next one.